Good morning, everyone. Good morning to all the participants on this webinar, which is on the UAE corporate tax and the recent updates which have happened post the introduction of the law. Before we start the webinar, certain housekeeping rules. If you face any technical difficulty, please raise your issue in the chat box and our IT team will get back to you and resolve those issues. We've structured the webinar to be approximately 45 minutes of discussions. Post that, we'll have a Q&A session. If you have any questions, you will have a Q&A chat box on your screen. Please feel free to add your questions there and we'll respond to as many as we can. The webinar is being recorded and we'll share the recordings with all the participants and the registrars post the webinar. The speakers today, I'm Kapil Bhatnagar. I'm an associate partner with the firm specialized in transfer pricing. I'm joined by my colleague Hani and Venkat. Hani is an associate partner with the firm looking after corporate tax and the Middle East taxes. Venkat is a corporate tax partner and he specializes in structurings and tax advisors. The agenda for today, we've split it into three portions. One is discussions about the recent developments on the UAE corporate tax law, what has happened. We've recently, the FTA has issued an explanatory guide, which was issued. We'll discuss the overview and the nuances around what are the updates and how does it really impact and clarify the UAE corporate tax law and certain action points for taxpayers, for people, for businesses in terms of now with a lot of clarity being provided by the FTA on the corporate tax law, what is next for taxpayers, and then we'll have the Q&A session. So the journey so far, post the announcement in December, we've seen the evolution of the law of the UAE corporate tax. Now, we've seen a lot of decisions being released by the ministries and the FTA, and there are certain cabinet decisions as well. And there is also a guidance or an explanatory guide which has been issued by the authorities, which really clarifies and provides meaning to a lot of aspects which are enunciated in the corporate tax law. The tax registrations for private companies and PJSCs has also started, and it is an opportune time because the rollout is just around the corner and the corporate tax becomes effective from 1st of June 2023. The big question, however, still remains on Pillar 2 and whether the Pillar 2 impact and when it will be applicable for us. The speculation, however, always remains whether it is going to be 2023 or 2024 or 2025. In terms of the decisions and the guidance, while there are 14 decisions and guidance which are being issued, there are a few which were released before the introduction of the corporate tax law, which were on the determination of tax residency, and we have a big explanatory guide being issued. So apart from the 14 decisions, we have a tax residency decision also being rolled out and an explanatory guide. And in this webinar, we are going to discuss some of the key aspects of all these decisions and pick up some of the significant ones. In terms of some of the key decisions which have been released, while it was being clarified in the FAQs, what is going to be the corporate tax rate, it has been further mentioned in the cabinet decision that typically there would be two rates of taxes, a 0% and a 9% for an income up to 375,000 dirhams and more than 375,000 dirhams respectively. In a very big decision which pertains to small businesses, it was clarified that the revenue threshold for the applicability would be 83 million. However, there are certain exclusions to this particular revenue threshold, which would mean that entities which are part of these exclusion list will still need to comply with the corporate tax law. The reliefs which have been enunciated are available for tax periods ending on or before 31st of December 2026. In terms of tax registrations, there are certain exceptions being provided to certain categories of persons who are not required to obtain a corporate tax registration. They are typically government entities, people who are engaged into extraction of natural resources, and if there is a non-resident company which does not have a permanent establishment in the UAE, all these three need not register for a corporate tax registration. However, exception has not been granted to other categories of exempt person, like qualifying public benefit entities and qualifying investment funds. Those still need to comply and register themselves on the portal, which will be released soon. In terms of the timelines for application for exemption of corporate tax, typically, and it again becomes a very big relief and a very big aspect for businesses. The businesses will get 60 days time from the end of their tax period to apply for an exemption and to check whether they meet the conditions or not. Now, this really means that the taxpayers can really go ahead, complete the tax period, look at their business activities, look at the conditions under the exempt category, and assess in the next 60 days whether they fall under the exempt category or not, and then file an application. In terms of the changes in tax period, and there has been a lot of discussions in terms of how the tax period changes will be looked at by the FTA. The FTA has clarified through a decision that under certain conditions only the permission of changing of the tax period would be allowed. Those are typically if the taxpayer is under liquidation, and then they may want to just have an abridged or a shorter tax period. Those cases would be permissible. If you are aligning a financial year with to form a tax group, there could be many similar entities within the tax group which have different fiscal years or financial years. If you're aligning your financial year to form a tax group, those conditions would be allowed and permissible. If you're aligning your fiscal year or a financial year with the head office and you have an overseas head office and you're aligning according to that, even those conditions would be allowed. Or you give, or the taxpayer provides valid economic or legal reasons to do so. These could be business restructurings, these could be any other changes which may be happening, etc. There could be mergers, demergers, and hence under those circumstances, typically, the FTA would accept those applications to get the tax period changed. The tax periods, the FT has clarified, can be anywhere between 6 to 18 months. So you cannot have a tax period which is more than 18 months. You cannot have a 20-month or a 24-month, which is again globally not accepted. In terms of preparation and maintenance of audited financial statements, this has also been a very big discussion within the family groups, that do we need to really get each and every entity audited and prepare audited accounts. We've seen in structures that typically small businesses may not have audits, procedures, or audit reports being created for smaller group of entities. It has been clarified that taxable person deriving revenue exceeding 50 million should get their accounts audited, or if the taxpayer is a qualifying free zone person, then it's a mandatory requirement to get the accounts audited. Another big significant decision which recently came out was on the coverage of natural persons under the corporate tax law. It has been clarified that the natural persons would be covered under the UAE corporate tax law only and only if the business turnover exceeds 1 million in a calendar year. So if it does not exceed a 1 million dirham threshold, while the natural person is conducting a business through a business license, no corporate tax applicability is there. Again, wages, personal income, real estate income, etc., are not considered as business income. And when you're calculating this threshold limit, all these income streams need to be excluded while computing the applicability. We've also, the FTA and the ministry has recently issued an explanatory guide, which really details out and provides, like I said, a meaning to the law which has been announced in December. And we'll discuss what are the contents, what are the overview, and how does it really impact the taxpayers. In terms of the contents, it really provides an explanation, and each article has been explained in detail by the under this explanatory guide. It has been clarified that it must be read along with the UACT law and the decisions. It cannot be read in silo and cannot be interpreted in silo. This can be subject to changes from time to time. Obviously, the law is evolving in the region, and hence we are expecting that whenever any additions or new ministerial decisions come in, the contents of this guide will get updated. Typically, it really gives an increased clarity to taxpayers. It helps them to plan, it helps them to assess their compliance requirements and their needs, and really gives a very wide ambit of how the FT is looking at implementing this corporate tax law in the UAE. We'll start with the transfer pricing provisions first, and we thought that this is a significant aspect which impacts a lot of taxpayers in the region. In terms of transfer pricing, there are two actions which the ministry has done. One, a specific detailing has been given in the explanatory guide with respect to the nuances or respect to the articles of transfer pricing, how transfer pricing regulations will be applied. And two, there is a ministerial decision which was recently issued, which talks about the threshold and the applicability of transfer pricing regulations on the various taxpayers. In terms of the highlights under the explanatory guide, it has been clarified while it is coming from the law which was announced in December. But then specifically, it has been mentioned that the arm's length price will need to be tested for all controlled transactions. It really means that transactions need to be adhered to as if they were held between two third parties and were in an independent scenario. And there is an interesting discussion in terms of what independence really means. And that is something which we'll discuss in the coming slides. It has also been clarified that the ALP needs to be determined through the 5 methods. Combination of methods is allowed if any of the 5 methods or a combination of method is something which the taxpayer cannot utilize to justify the arm's length price. Any other method can be used to evaluate the arm's length principle. Now, it really gives the flexibility to the taxpayers in terms of how businesses work, how crucial or complex transactions can be looked at by giving justifications from the business perspective. Whenever there are the transactions are not at arm's length, the authorities have the powers to adjust the taxable income. A corresponding relief will be provided to the taxpayers, which really means that if a taxpayer in the UAE has suffered a transfer pricing adjustment, a corresponding relief will be provided to the other related party, which really eliminates the risk of double taxation. Again, if there is a cross-border adjustment of transfer prices, then typically applications can be made to the competent authorities, and hence there is a detailed mechanism of an advanced pricing arrangement which comes into place, which really helps the taxpayers to resolve these bilateral disputes. What has been clarified specifically now in the guide is that there would be no hierarchy of which when you're applying the transfer pricing method, which really means that whenever a taxpayer is justifying a transaction, they need not follow an elimination concept of eliminating each and every method one by one. They can straight away discuss and talk about the methods or the method which is applicable or which will be used to justify the arm's length price. As a best practice, it is always better that in the local file, the rejection of those other methods or those 5 or 6 methods is there. But then typically there is no hierarchy of method which needs to be followed by justifying the arm's length price. It has also been clarified that the range will be preferred over an absolute value. There are certain jurisdictions across the globe which talk about a mean or a median to be an arm's length price. Interestingly, the UAE has followed the OECD principles to say that a range will be preferred over an absolute value. Whether this would be an interquartile range or a percentile range is something which we are awaiting clarifications, and we'll hear it from the FTA pretty soon. In terms of few other explanations which have been given in the guide, the related party concept has been elaborated and discussed, and it really talks about that any transactions between juridical persons which are related to each other, either through ownership, control, or kinship, would then typically get covered under the transfer pricing purview. Again, the payments made to connected persons will not be deductible unless they are made at market value. Now, this is a significant one. However, there are reliefs provided to companies whose shares are traded on the recognized stock exchange. And hence, if you have a taxpayer or a case where the taxpayer's shares are uh, traded on a recognized stock exchange, any payments being made to connected persons of such a taxpayer are exempt from transfer pricing principles. In terms of tax groupings, transfer pricing regulations are not applicable within the tax groups due to the elimination of those transactions. It would be applicable if there are two tax groups and any member of these two tax groups individually are interacting with each other. Transfer pricing typically would apply to them. We've also received or been, the FTA has also issued a ministerial decision 97 of 2023, which really talks about the thresholds of applicability of transfer pricing regulations and the maintenance of local file and master file. The formats, however, for a master file and local file, while the OECD has provided, the standard templates, but however, a UE specific template for a master file and a local file and the TP disclosure form has not been released and they're yet to be prescribed. The APA mechanism, the advanced pricing agreement mechanism, is in place. It is again being clarified under the explanatory guide, which really means that any taxpayer who needs a certainty on their transfer prices much before getting into the transaction, they can approach the ministry and the FTA and get a certainty through an APA mechanism. In terms of the highlights of the ministerial decision, and this is a significant one which has happened in the recent past, the thresholds for maintenance of local file and master file have been prescribed. It typically says that the taxpayer will be required to maintain a local file and a master file if the total revenue in the relevant tax period is at least 200 million dirhams, or the taxpayer is a part of a multinational group, which means that the consolidated group turnover of that group is typically 3.15 billion dirhams. In either of these two conditions, typically if a taxpayer meets either of these two conditions, the requirement of maintaining a local file and a master file remains. What it really means, and one question which really comes to our mind is that whether a benchmarking analysis or an arm's length testing of transactions, if the threshold limits are not met by a taxpayer, does that need to be done? Now, interestingly, while the thresholds for local file and master file have been detailed out, the threshold limit for filing a TP disclosure form have not been prescribed. And it could be assumed that there are no particularly thresholds for maintaining or filing a TP disclosure form. The TP disclosure form has to be filed along with the tax return. Now, typically in the GCC region, we've seen that whenever, or in other jurisdictions as well across the globe, whenever such kind of a declaration of transfer prices or transactions with related parties is done along with the income tax return in a disclosure form, typically the authorities also ask that what is the method through which the taxpayer has justified those transactions. Now, if that really happens, then taxpayers will need to justify each and every transaction through a benchmarking analysis. And hence, while the local file threshold or local file applicability may still not be there, but typically determination of arm's length price may still be a compliance requirement. This threshold limit really gives a very big relief to small businesses. It's a very big relief. Their compliance goes down in terms of maintenance of master file and local file. They don't need to maintain these documents. However, since for people or taxpayers on whom these two local file compliances and master file compliances apply, it is recommended that these should be done on a real-time basis, because these documents are to be submitted with the authorities as and when asked within a period of 30 days. And hence, it is our recommendation that these documents are maintained on a real-time basis. In terms of the inclusions and the exclusion list, what needs to be included in the local file and what needs to be excluded in terms of the local file and the transactions, it has been clarified in the ministerial decision that transactions with non-resident persons need to be included, which means that international transfer pricing, or whenever an entity is interacting with their international or overseas subsidiaries, all those transactions need to comply and need to be a part of the local file. Again, if a taxpayer has transactions with an exempt person or has a transaction with a resident company which has elected for a small business relief, those transactions also need to be reported and maintained in the local file. Again, if the taxpayer is subject to a different corporate tax rate, you could have a group company in a free zone and you could have a group company in the mainland. And if the mainland entity is interacting with the free zone company, then typically, and subject to a different tax rate of a 0% and a 9%, then these transactions need to be included in the local file. What has been excluded under the list is a resident person which is subject to the same corporate tax rate. Now, this is a deviation from the FAQs which were released along with the corporate tax law, where it was interpreted that even transactions between two taxpayers which are subject to a same corporate tax rate, transfer pricing will still apply. Now, it has been clarified in the ministerial decision that these transactions need not comply with the local file and the master file regulations and the compliances, and this really becomes a relief and reduces the compliance burden. Again, a natural person, any transactions with natural person, if at all these transactions are being done independently. Now, this can be used by the taxpayers to justify any payments being made to connected persons, to promoters, to demonstrate how the transactions, whenever they were entered into, were acting independent. Now, the onus again is on the taxpayer to justify how the independent nature was attained. But typically, it really becomes now a burden on the taxpayers to say, I need to exclude myself from complying the transfer pricing provisions, but then I need to justify the independent nature. Again, the exclusion list covers a P of a non-resident, which is subject to a same corporate tax rate, going by the same principle that if there are two taxpayers at the same corporate tax rate, subject to the same corporate tax rate, transfer pricing would not apply. If there is a partner in an unincorporated partnership and the parties again are acting independently, then typically these transactions need not be reported under the local file. Now, what is independent? And we've been talking about that the taxpayers need to demonstrate that these transactions were under an independent scenario. It needs to be demonstrated that they were undertaken in the ordinary course of business. It is not an exceptional item or an exceptional favor or an exceptional transaction with the related party. And hence, that would demonstrate typically the independent nature of those transactions. And again, the parties have not exclusively or almost exclusively transacted with each other. It should not be typically that a captive service provider interacts with its group company and then wants to qualify under the exclusion list. If you have a captive service provider working exclusively for a group company, then typically those transactions will not be held to be independent and will need to be tested from a local file compliance. What are our points for discussion? We've seen the explanatory guide coming out and we've seen the ministerial decision, but there are certain open areas and certain discussion points which we need to watch out for. One, whether the transactions which are there between the mainland entities, would they need to be reported in the TP disclosure form? Now, while the local file compliance for such transactions are not there, that comes under the exclusion list. But typically, whether those transactions would need to be reported in the TP disclosure form or not is still not clear. In terms of the free zones, and that is a big one, in terms of the free zones, if they do not meet the AED 200 million threshold or a group company or a consolidated turnover threshold, will they still be liable to maintain a local file? Because they are subject to a beneficial tax rate of 0%. And hence, even without not meeting the threshold, does the free zone entity need to comply with the local file or not? What would happen if the threshold limit for a TP disclosure form is lower than the local file? It should not happen, but typically, like we discussed, that the local file has a turnover threshold of 80 to 100 million and above. The threshold limit for TP disclosure form has not been declared. Then typically, for the taxpayers, the compliance requirement still remains. Again, the deviation in terms of the law, which was enunciated in the FAQs, where similarly taxed companies need not comply with the need to comply with the corporate tax provisions and the transfer pricing provisions, was detailed out. But the ministerial decisions typically takes that away and says that only differing tax rate taxpayers need to comply with the corporate with the transfer pricing principles. Again, in terms of the threshold limits, it has not been clarified whether this threshold limit for local file will be applicable to taxpayers, to tax groups or not. It is still awaited, and we are expecting further clarifications by the FTA on these particular aspects on transfer pricing. Now I hand it over to my colleague Hani, who will just discuss upon the other updates on corporate tax.
Thanks, Kabir, and good morning, everyone, and good afternoon. Also, someone joining us from different zone from UAE. So, as Kabir mentioned or highlighted, we have now many clarification, many guides published by FTA. FTA is very active about publishing new clarifications. So, to take you through some main aspects quickly, let's start with one of the guides which published regarding the competition of taxable income. We have, if you remember, we have this participation exemption already covered by CT law, but there is some uncertainty or some clarity needed for some aspects which already clarified by FTA or Minister of Finance by the decree published. Like ownership interest, it now means, or it already have been clarified as a legal and beneficial ownership. For permanent established as well, or foreign juridical person can also claim benefit of the participation exemption, which was not clarified or not covered before. Regarding entertainment expenditure or expenses, entertainment, it would be deductible up to 50%. As already covered by CT law in UAE. However, it will have been clarified it will not be applicable for expenditure incurred on employees. If we also go for interest, definition now is wide. It's compensation for use of money or for debit obligations. Interest recognition as per IFRS 16, which lease may not fall within ambit of interest. Loan from related parties, both GR, which general anti-abuse rules and specific anti-abuse rules to be looked into, and we should be very careful also about this one, especially when it comes to GAR concept. For market value, deeming provision in case of transfer, if we have a transfer of asset to a related party, it can be deemed provision, or for either related party or connected person, like Kabil covered in TB part, so that we have two definition now for related party and connected person. However, market value to be deemed as consideration for transfer. What we are wanted to highlight here is that a significant impact on asset transfer within the group companies, which will benefit of qualifying group and restructuring relief will be not available. Coming back again for deductible expenditure, expenditure is allowed as deduction when it's incurred. Now it's have been clarified what mean by incurred. Meaning of incurred, it means that in case of cash accounting, when expenditure is paid, in case of accrual accounting, when obligation to be arise. So the words of irrecoverable committed for the payment could cause disallowance of read narrow. While we are speaking also now, Minister of Finance published, released some new 3 decrees, one of them for accounting standards, which cover also for cash accounting, And they listed down some conditions that if the taxpayer wanted to follow the cash pays, if he have shareholder revenue less than 3 million, that he can follow this cash concept. So we see, like we mentioned, MOF and FTA is very active about releasing decrees. However, we still also, because it's just recently published now, we will also share our view for these three decrees later. BOM, one of the main aspect or main topic now in UAE, which place of effective management. Also some clarification already published through the decrees. We can highlight some of them here now in the slides, that like foreign juridical person regarded as a resident of UAE if effectively managed and controlled in the UAE. BOM is created when key managerial and commercial decisions necessary for conduct of business are in substance made at a place other than its place of incorporation. BOM, it's one of the very hot aspects or topic, even from our experience also in other countries in the region. The three main aspects or topic which always tax authority focus on them, like TB and BE and BOM. It's there is additional guidance by explanatory guide already published, already released, the determination of BOM fact to be established, where key management and commercial decision concerned with broader strategic and policy matters and regularity or predetermined made. So this can be the place where company's board of director or equivalent body, in case of other type of format of the company or juridical person are made, and location of controlling shareholders also relevant. So in case of BOM applies, global income of foreign juridical person is subject to tax in UAE. Permanent establishment, of which we are very famous for saying BE. So maybe some of the audience or taxpayer will ask this question. Okay, what is the difference on distinction between BOM and BE? BE, it includes place of management, where decisions that are necessary for day-to-day business conduct of the foreign entity business in substance made. Distinction is required to be made between board or equivalent senior management of the entity who takes strategic business decision and day-to-day management which implement the business decisions. So other clarification on context of BE already released as well. So scope of BE could be expanded by cabinet decision. Any economic or business link to the UAE could be covered here. And further clarity on anti-fragmentation rule provided. Anti-fragmentation rule, in summary, if you have a contract and you split it, if you have this contract with a related party and you split it, and you say that there is no BE here, so FTA, they have the right to say, no, we will, this splitting of contract, it will be one contract and we will investigate more how it's BE created or how it be connected or person or related party or arm's length would be applied here. In case BE of non-resident and constituted in UAE, income attributed BE shall be subject to UAE corporate tax, of course. Now I will hand over to Venkat to cover free zone and other aspects. Thanks.
Thank you, Hani. Thank you, Kapil. A few slides which we thought we'll cover towards the end, not in terms of importance, but it is just something which will engage everybody in the UAE and free zones. People have been expecting, clarifications on what the qualifying income will be. That said, there is enough until now, including the fact that juridical persons who are incorporated will be a free zone. There will be branches of a non-resident also who will be considered as a free zone. But and a free zone could also be a entity which is it's the branch of a mainland entity. and therefore those would also be free zones. Having said that, there are some nuances which have been brought in, that if a foreign jurisdictional person, which is, in the POEM concept, there was a thought that if there is a free zone entity in UAE, which is, accepts that they are managing an overseas entity and the POEM is therefore coming into the UAE. And the belief was that if a free zone entity is holding the POEM in that sense, then the foreign entity, even if taxed in UAE, should be a free zone. That has been specifically clarified. No, that will be treated as a mainland entity. So those, thoughts around those planning, or even if there was no mitigation of that POEM aspect, will not protect you from being treated as you will not be treated as a free zone. You will be treated as a mainland company. And of course, the basic exemption and the basic limits will not be granted to you. Of course, the basic limits should be given if you're opting for the 9%. Dividend. This one needs to be a little careful on this, even as companies and who distribute dividends. So we all understand the ordinary meaning of dividend, that is on shares. You would give it post profits, EBITDA, then you would say, after that, what is my appropriation? I give a dividend to my shareholders. Fine, that is dividend. What is also being considered is that because individuals are tax-free, and there could be beyond connected persons, beyond the KMPs, there could be connected persons, or there could be KMPs who you want to reward, and they're also significant shareholders. And it is not after taxes, but you are trying to take a deduction of expenses, but the payments are a result of a calculation based on profits. So if somebody were to say that there is so much of percentage of profits which will be given away to some people, distributed as some people, and then you seek to claim it as an expense, you could have a difficulty, because what is sought to be said is that these are contingent, they were never clear, there was never for services, and therefore it is dividend masquerading under different charges. Now, this brings in another set of questions, that if we say that dividend, which is, we understand dividend is not tax deductible, but if payments which are contingent, which are performance based, or which are linked to certain milestones or certain KPIs which have been put for KMPs or certain people, that is in the ordinary course of business, one would do all those things. Now, why would you say that those are contingent and dividend? So the question is, we have to set an answer saying, what is the substance over form? Is it a normal employment or a benefit of services rendered by the persons to the companies, and it is not a payment which is otherwise would have gone as dividend, but you were cleverly structuring it in this way, and that may not be favorably looked at. In fact, that will be disallowed. So one needs to watch for those agreements and watch for those type of transactions if one were to do it. Otherwise, the ordinary meaning of dividend continues. This has been a debate in the UAE as to, and this list is yet to come out, and the decisions have to come out. So this explanatory memorandum clarifies on the government entities. Government entities are pure controlled by the ministries or the government officials. That is pure government departments, no worries. There could be an entity which has taken a juridical form, which the government has formed, and the government has used it as an arm and extension to do its work. And that would be a government control entity, while the full list will be out, and there will be decisions which will be explained in the public, etc. Ultimately, where is this income going? So there are a lot of entities in the UAE, and for historical reasons, all the right reasons, historically, many have been set up by decrees, or the state set them up for doing a particular purpose. There were no private sector companies at that time. And there were reasons why these companies were set up, on these entities. Primarily, they may not even have a control over their prices. They may not have control over their revenues, etc. They may be providing, some bit of a government service, but they're also now corporates, and they also have shareholders. This puts in a dilemma. Should you exempt these companies completely because they are doing more of a government service and they're not a pure private? Or should you treat them as private because they do have private shareholders? The shareholders are not, the directors are not necessarily fully government employees or government officials. They could be other private stakeholders. The distribution of profits may be going to the private sector or to private hands. They may be even listed. So there is a lot of facts which one will have to walk through and then figure out as to whether you are a government control entity apart from being listed. So the chances are, if you are a government control entity which the government seeks to give an exemption, you will be probably listed in the cabinet decision, and therefore that takes you out of this. But if not, you may have to do some more fact finding and more case, and then maybe you have to apply to the government to say, should you be considered? So that could be one aspect of this government control entity. The qualifying public entity, just for this thing, this is, these are entities which are meant predominantly for charity or good work, and they are meant to be not necessarily for profit, although if they generate a surplus, they are used for the activities which they are set up for. So typically they are, they can be formed by anybody, but the purpose is, as we say here, humanitarian, cultural, and they're not for, in that sense, profit. And the wide public and the larger public has an access to these facilities, and it is not a select club for certain select set of individuals. Yeah. So what's next? If you just step back, all of us need to step back and say, the act has come. Then there are multiple decisions and clarifications have come. In fact, just as we started this webinar, there is a ministerial decision on the participation exemption. What is the threshold, accounting standards to be followed, the definition of an investee, what is the monetary limits. As we speak, it just came out a few minutes before this webinar started. So there will be multiple clarifications given before June, and hopefully, it will continue where required. So we have the body of the act, we have the body of decisions, we have the body of clarifications. But there are some more yet to come, and we have listed out some of them. The government control entities, which we spoke about, what are the free zones? And the second, the number 2, which I have on this list, is the big one where a lot of companies and a lot of enterprises are waiting for this. Then there are finer aspects because of the definitions given, the nexus rules in case of non-residents. Then what would be the category of states? What type of incomes would be state sourced? Because then there are implications there. The 0% withholding is mentioned again and again. So, that's speculative, but, you will look at what can happen if the 0% changes in a future period. How do you make adjustments to your financials, etc.? And the last one is globally, and there are different countries doing it differently as 1st January 24 or 25. The question is, when is UAE going to bring out a set of rules for Pillar 2 applicability? Because when that happens, it takes the tax rate to 15% for MNEs. So if you're an MNE in UAE, headquartered in UAE, your tax rate may not be 0 or 9 wherever you're falling, or in between or whatever. Because it depends upon where your business is structured. But if you're an MNE, you may end up having qualified as a MNE, the BEPS Pillar 2 taxes, which means the top-up tax, and take you to a 15. So where do we stand here? We have a lot of material already on the table, which allows us to plan and do stuff, but we have to still get a lot of decisions. So there could be what impacts each business separately. Free zone, arguably is one thing which people are waiting for. And then there are technical issues on nexus, etc. So there is material which you are waiting for, but there's a lot of stuff which has already happened. Yeah. So what do we think? Companies should be doing? And as we speak to many of our clients, many of the companies where we are privileged to work with, tax registrations is something which you will pick up immediately. You can decide to form a group later. So whenever you're invited or whenever you're eligible, there are mails which have come, you would do your tax registration maybe on an individual basis. Arguably, the group formation is not something which you have to do today until your return is due, unless there is a guideline to the contrary. You will look at cabinet and ministerial decisions and review the impact, because that could impact what you decided 1 week back or 2 weeks back in case there is a clarification. The point number 3, which we say CT impact analysis and implementation. This is going to take a lot of time, if it hasn't already, of major companies. In fact, anybody who is affected by corporate tax. Look at your accounting policies, look at your existing structure, look at how you're ready for corporate tax, the impact of all this, what is how does it land on your accounts? Are you at 0%? Are you at 9%? How does your group look like? What does your grouping look like? What is the compliances which you will do ahead? How does transfer pricing impact you? Do you need to go for a clarification in advance to the FTA, or do you wait? Do you wait to see what happens otherwise? Do you go to the FTA proactively? Extreme, you go for advanced pricing arrangements and transfer pricing. May not be today, but you'll start thinking about them. The FTA will, of course, come out with a mechanism, how they will clarify and how you will apply to them, etc. MNCs covered by Pillar 2, at least the local ones, headquartered here. If you're an MNE from outside coming here, you're impacted by the, what that home jurisdiction does. But the UAE will bring in laws which say that if you're going to pay a tax elsewhere at 15, then you might as well pay it here, one. And number two, for MNEs here, if you're outside besides the UAE, if you're in any other country and you're impacted, then how does your collection mechanism go? So many corporates who are also at 0 or 9 will now have to start thinking, if they're at 15, how do they go about it? Of course, your ERP systems and your system readiness. I would request all of us to just take a look at the 4 points we have put out on side as a parting thought. There has been a lot of literature, and it is very tempting for us to plan different ways, be clever, or not necessarily grounded on facts and practices. I think a careful corporate and even tax advisors need to say, what are the facts before a company? What are the past practices? Where are we? Take stock of what we have done so far. Where are we? What is our business? Be aware of the law and the provisions, and be aware that the FTA is clarifying and it is explaining things, and it is expected that all of us as good corporate citizens will be within the 4 corners and will follow the law as intended, and there will be consequences for not doing it. Unless you want to be very, very rash, or which is not advisable, you will not ignore substance over form. Does it mean tax planning is dead? No. Even the explanatory guideline says that optimization of taxes is not discouraged. An evasion or an avoidance will be obviously frowned upon or discouraged. So substance over form, what is the transaction? What is the substance of it? And how do I do it? Last but not the least, we are forgetting that companies have limited resources, whether in terms of the people they have or the access to resources externally which they have, and of course, just the internal infrastructure. There's a lot of work to be done when you are ready. And if I'm assuming your tax year is starting in July, then of course you are working overtime nowadays to get ready for that. And there are many companies which are doing. While the tax return may be 9 months after the tax return, there are a lot of things you have to put in place before your accounting year starts. And therefore, there is a limited amount of management bandwidth, senior management definitely limited bandwidth, and down the level, the execution teams. So if you put all this, which we have in the next steps together, you must take stock of it as to where you are in this journey of going for CAT planning and implementation. How does it impact you, and where will you land? And therefore, what all next steps you need to do. And there are plenty of action steps to be taken for you to be ready to make sure that your group is well optimized. And then, of course, you comply with the law and eventually file your returns. So that's just a thought which I thought we should all be mindful of, and so that we are best prepared if we are not already taken the steps. Yeah. With that, I think we will go into a Q&A. And post webinar and during the webinar, anytime if we have, we will address the questions which we get in. And if there are some in the chat box, we will pick them up. Other than that, I have 2 of my colleagues here, and you can note their email IDs. And if you write to them, they will try and address any question which you have, anything which we were not very clear on the slides in the past. I saw a couple of people were not clear on some of the slides. Happy to clarify that and explain that. Shoot your questions.
So thanks, Venkat. I have the questions listed down, and the first one is actually to you. The question from one of our participants is that if a free zone entity has both qualified and non-qualified income, whether whole income will be disqualified from getting the free zone tax incentive, or only the portion of the non-qualified income will get disallowed.
I wish I could say that answer with great amount of certainty because FTA has to issue the guidelines. But I think if I make a normal interpretation, and they are suggesting that you could have both the streams of income, which also suggests that you will have, a stream at 9% and a stream at 0%. Hence, the basic limit will not be given to you and how it will be done. And so the suggestion seems to be that if a mainland company can have a free zone branch and a free zone company can have an income which will be taxed at 9%, the suggestion seems to be it may not taint it. But if you were to ask me separately, step back and say, what is the ideal situation? As we are recommending to clients whom we work with, that if you can, ideally, don't mix it up, keep it separate, because it may not be intentional, but you could be missing up on the cross charges and you may be missing up on how you maintain your records. So ideally, if you make the discipline of separating them, you're better off. The answer to the question, as it seems now subject to a clarification, it is possible without tainting it. Would that be the safest and the easiest practice? My answer would be each one to his own, but I would suggest segregation only because I want to be absolutely sure of myself.
Thanks, Venkat. And another interesting one which has come up, which talks about that whether interest classification as per the IFRS 16 leases will be considered for, calculating the thin capitalization or the interest limitation purposes or not.
So, there is, all of us have read the clarification. It talks about debts due and borrowed, etc. And therefore, it is not a money's due. And so therefore, the interest which comes out of an IFRS 16 classification should not be taken into disallowance. That is fine, but I would like to have a very specific clarification or a very specific understanding from FTA, and I'm hoping that they will do this only for one reason. I'm with the definitions part. But if all along you have said that IFRS is your basis, and there is a decision even now which says IFRS is your basis of accounting, and if in IFRS I have classified it as interest, how do I go about splitting it and showing my accounts, and what disclosures do I need to say that this is sort of reclassification, and how do I keep my records? So yes, from a conceptual point, it should not be considered for disallowance. Having said that, if we are saying IFRS is the basis and you classify it as interest, how are you going to go about segregating it? So would love a clarification from FTA on this, just to be on the safe side.
Perfect. Hani, next one is for you. One of the questions is that, could you please clarify if the standalone audited financial statements would be required for the parent company or a consolidated FS is enough for corporate tax purposes?
Yeah, thanks, Kabil. So it depends on the registration itself, but it can be consolidated. One can be also covered or can be enough for tax purpose in UAE.
Perfect. Thanks, Hani. Another question on transfer pricing, and we have 2 to 3 questions coming up on transfer pricing. We'll pick up the first one. It says that how to deal with arm's length price in case of transfer pricing, where there is a financial assistance being provided to related parties on a cash-to-cash basis, that is without any interest being charged, whether it should be classified as a pre-operative expense or over a period of time to avoid cash crunch for business expenses. Now, it really depends upon, ideally, typically these kinds of financing arrangements which are there, on a cash-to-cash basis without any interest charge. Ideally, there should be an interest. But then again, the substance or the nature of this financing arrangement needs to be understood and documented. If it is more like, let's say, a receivable payable, then typically we don't have any deeming provisions or any imputed interest being calculated on long outstanding receivables, and hence transfer pricing typically doesn't apply. But then in cases of financial assistance being provided on a regular basis, ideally an arm's length determination of such short-term credits should be calculated and demonstrated and benchmarked accordingly. We have another question on transfer pricing, and I'll pick it up. It says that we have a free zone company, and typically the threshold limit of the turnover is less than 200 billion. Will there be a requirement to file or maintain a local file? The answer is still not clear. Clarifications are awaited. We've discussed in our slides earlier is that it is a good practice to at least maintain and demonstrate that the transactions were at arm's length. Now, to document that into a local file then really becomes easier. And typically for taxpayers, the key would be to have a real-time backup documentation being created. Because the moment backup documentation is there with the taxpayers, converting those into a local file typically becomes much, much easier. Our recommendation would be to have a real-time analysis of the documents which are being maintained and typically put them in place and in perspective so as to whenever the authorities typically come back and ask them, they are readily available with the taxpayers.
Maybe,
We have
sorry,
yes,
maybe,
yes, Hani, sorry, please.
yeah, maybe more clarification on financial standalone basis, because maybe some of the audience it's not clear to them. So as we know that for standalone audit financial statement, if it's for this question about the parent company or standalone or consolidated one, okay? So standalone financial to be prepared if the return is filed on a standalone basis, okay? In case of entities are tax grouped financials, then we have to be, then the constituents have to be prepared. So it's just more clarity about this question. So if it's not clear to us.
Perfect, Hani. Thank you so much. Venkat, we have another one for you, which is in relation to the dividend aspect. And, you discussed at length how, transactions are being looked at or would be looked at by the FTA. The question reads like this: the remuneration model of the KMPs of the company are based on the financial performance of the company in order to incentivize them. And these could be year-end bonuses, performance linked, etc. Whether all these payments will be covered under the meaning of dividend or not.
Kapil, my first answer would be no, it cannot be, because these are contracts which are very normal globally, even in the UAE, where incentives are given to KMPs who are actually managing the business, and there are incentives provided to them. But like I said, you have to be a little careful here. Did you introduce all these agreements after the CT law came in, or were they always there historically with you? To me, if you introduced everything yesterday, or you're planning to bring it in today, there could be a greater degree of explanation which you may have to say as to when these agreements came in. Merely because there is a profit mechanism, my sense is merely because there is a method to calculate how much bonus or how much variable you will get based on a profit, should not throw it out. I think the mischief of what the FTA is trying to capture is that you try to claim a tax deductible expenditure which you would have otherwise paid tax and given dividend. I don't think the objective is to avoid normal rewards given to a KMP who's anyway otherwise working for a business. And I would suspect that from a connected person's point of view, Kapil, you would do a transfer pricing benchmark to satisfy that these seems comparable to the market rates and etc. So I think in abundant caution, companies may just want to go and get a private clarification. But my sense is, if it's in the ordinary course of business, which is given to more than one employee, related, unrelated, and it is for compensation of services, this should not catch you as to saying this is dividend merely because you have some shareholding also. But that should be the way it is looking, not something which was just created to avoid tax.
Absolutely, Venkat. And I think we've been suggesting clients, and we've been, whenever clients have come to us on these typical questions, any unprecedented hike in a year prior to the tax period, is going to be looked at by the FTA very minutely. So, if you did not have a performance linked, payment plan or a bonus prior to the introduction of the corporate tax law, and now suddenly, these kind of incentives or perquisites come into play, then typically there could be a disallowance from a transfer pricing perspective, and the commercial rationale of such payments could be challenged.
Yes.
And then, which again brings to another question, and this is somewhat linked to a GAR provisions. It says that the grandfathering of GAR provisions, it is from the date of the publication or commencement of the relevant tax period.
So, Kapil, all of us, when we thought on 9th December is when the law came out, and 15 days after that, 24th, then we realized that the law came out on 10th of October in the Arabic version. We hadn't seen the English version. And 15 days after that, it is applicable. So the GAR provisions are applicable on 25th of October, 15 days after the law came in. and everything which you do after that is subject to GAR, while the Act and the provisions may apply in your tax period whenever they start. The anti-abuse provisions are probably in place on 25th of October 22. So, you may have explaining to do, notwithstanding what happened, just before your tax year. GAR provisions apply in the sense that they are already operative.
Thanks, Venkat. And I think we just have, space for one or two more questions, or probably the last question. It says that whether salary payment to an employee who's a related party of the owner and not the managerial staff shall be looked into for compliance with transfer pricing in case of free zone companies. Now, it's a tricky one, to be honest, because generally the salaries which are being paid to employees, and they are not shareholders, they're not owners, business directors, or KMPs typically, is not under the purview of transfer pricing, because that's a payment made to an employee. Now, what needs to be ensured is that whether these payments and these terms were agreed in an independent scenario, that's something which has been clarified under the under the guide. Now, the fourth degree of kinship and those conditions of ownership and control and connected persons need to be evaluated, whether this employee who's a related party or connected to the owner would fall under that category or not. And then again, if it falls under that category, the independent nature of those transactions need to be demonstrated to ensure that the arm's length principle is maintained. Like we always say, and which I mentioned, is that there should not be a sudden hike in the salaries being made to such connected persons and related parties. If it has been there for the past 5-6 years and the same salaries with an industry level increment and bonuses have been granted to the employee on a year-on-year basis, that is a reasonable justification to determine the arm's length nature of such transactions.
Yeah. So Kapil, I think the question you also said that this company is in the free zone.
Yeah.
So the temptation for somebody to make an argument that the company is in a free zone and 0%, and therefore I am not taking away anything in tax base, maybe an argument if you are not able to defend exactly, Kapil, on what you spoke about.
Yeah.
But I would urge companies, this is my suggestion, is that don't plan on that basis, that anyway I am not affecting my tax base and therefore it is a free zone. So never mind, it is not an arm's length, or never mind, it is not justifiable, I will pay. That may be a very wrong way to approach from a corporate governance, audit, comments, etc. So you might want to go to substance over form, services actually rendered, services actually valued, and then the right remuneration was paid and justified with arm's length or whatever it is, rather than the other way around saying it is not tax way, because that's a conversation which we have heard saying, how does it matter if I'm in the free zone? So maybe that's not a good approach to take. But
I think, Venkat, we should just wrap up. We've exceeded 4 minutes of our time. Thanks to all the participants, and we'll share the presentation deck with all the participants who've joined us. And the questions which we've left unanswered, we'll reach out individually and answer those questions to the respective people. Thank you so much.
Thanks for everybody who attended. Thank you very much from our firm. We as WTS Dhruva enjoyed bringing this to you and look forward to more interactions. Thank you so much.
Thank you all. Thank you all.
Thank you.